Good evening. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia, a registered investment advisory firm focused on the needs of Australians in America and Americans in Australia and those transitioning between. I'm so glad you could join me here for tonight's presentation, a comprehensive departure planning guide for those moving to Australia. Just to note before we get into things here, this does not constitute personal financial tax or investment advice. Attendees are welcome to ask questions as we go through, but this is general information only, and the information sourced here has been obtained from what we believe to be reliable sources. Do note we have a YouTube channel. I have about 50 presentations up there covering all manner of different topics, including last month's premium webinar, which was a comprehensive guide to claiming Social Security from Australia. That was a long one. That was a 90-minute presentation. There is a fee for that particular one. Proceeds for this go to charity. I want you to know that. This is not a moneymaker for us. This is something that we do to support the community. We provide very valuable information, and we alternate between free webinars and webinars where we make a donation to a particular charity. So a little about me. I was really born into this cross-border world, having been born in England to an Australian father, an American mother, grew up in Australia, moved to the US, going on 19 years ago now, just returned from living in Australia for 2.5 years with my family. So I've been there and done that in terms of the departure planning. Was a graduate of the University of Queensland, where I did IT and business management, moved to the US, as you gathered, in 2005, was drawn by the possibility of an exciting career in a big city, and worked in corporate finance until I realized I really didn't like it that much, but I was able to bring what strengths I developed in budgeting and cash flow and apply that for my clients in financial planning. I made the transition in 2008, became a planner in 2010. By 2012, Arete was launched. 2013 was sort of planning began in 2012, launched in 2013. And so I've been running now for 11 years. We work with about 70 households and manage a little over $80 million for our clients. I'm also the founder of the Global Financial Planning Institute, a membership organization for financial planners where I train them in what's involved in working with international and cross-border clients. Some examples of the kinds of clients and the situations that we assist with include the following. So the business owner living between Australia and the US, we set up a team of professionals for them, help them buy a home in Australia, getting a better rate actually than what was even available on an in-country basis. So we're able to do that with a relationship that we have with a particular mortgage broker. What about a high net worth Aussie family currently living in the US? Massive, saved them millions of dollars in taxes from what would have been their exposure to the HEART Act. They've since moved back to Australia. They had planned on staying in the US, but then COVID, Trump happened, and they decided to move back to Australia. The Australian executive and family having permanently relocated to the US. We've been working together now for 10 years with that particular client, and you see what we've done there. We've repatriated his financial life from Australia to the US in a compliant manner, and figured out a retirement income plan for him that really means the retirement of his dreams is possible. So, presentation for tonight. We're going to go through those particular steps you want to be taking 3 years out from your departure, 6 to 12 months out from your departure, about 3 months out from your departure, and shortly upon arrival. Note that tonight's presentation, the emphasis is on departure planning. There's arrival planning too. There's work to be done over the course of probably 12 to 18 months if you're diligent and you stay on it to get all of your financial loose ends tied up. The way I'm going to go through tonight's presentation isn't so much through slides, but through the knowledge engine that we've built here. And so let's I want to introduce you to this program. This is something we developed internally, and I'm extremely proud of it. What it is really a recommendations engine. So you can see this has been built for a blank client, but this will make more sense once I introduce it. So what I've done is set this up by time frame. So 3 years out from departure, you'll see the recommendations here mapped to what is in the slide. So there's no surprises, or few surprises. There will be a couple on the 3 months because we couldn't fit that into one slide. But let's get into it, shall we? So the first thing you want to be doing is about 3 years out. Now, there's no 11th commandment on the hill written in stone that says thou shalt commence their departure planning 3 years out. It could be 5 years out. I would say ideally 6 years out. And there's a reason for that will become apparent when we get talking about the Heart Act. There's a 5-year look back for moves, for substantial changes in your financial life. So ideally 6 years out, but to be honest, very few people, and I've been doing this for a while now, very, very few people plan a move as far out as 6 years. But the first thing you want to be doing is to familiarize yourself with the tax treaty and understand the tax treatment of earned income if you're going to continue to be working in Australia, retirement accounts, what's it going to look like to move your 401k or 403b or deferred comp or whatever the case may be for you, and capital gains assets. Now, it's very important to note that the top 3 recommendations you see here, the reviewing the Heart Act and deciding on your long-term immigration status, they are really codependent. So one determines the other. This is like a choose your own adventure story where, depending on your immigration status, it's going to send you in a very different direction as to how these various accounts are going to be taxed. The first thing we should note when thinking about the tax treatment is what's called the saving clause within the US-Australia tax treaty. And you can see I've got a screenshot here from the treaty, and actually a little bit lower, we actually have the treaty right here. But the effect of the savings clause is essentially to nullify any benefit that a US citizen or a permanent resident would gain by the tax treaty. What does that mean in English? If I was to boil it down, I would say if you're a US tax resident or permanent resident, you will, or sorry, US citizen or permanent resident, which collectively mean you're a US tax resident, no matter where you go. You go to Antarctica, Zimbabwe, or anywhere in between, you'll always be a US tax resident. Now, that's not the case for folks that have been in the US on some kind of temporary visa, be that an E3, L1, O1, et cetera, et cetera. Those temporary visa holders, once they return to Australia and they've relinquished their US tax residency, which can be done through various facts and circumstances. But once that has been done, they're done with the US. They don't need to continue on with a whole bunch of compliance and constraints that I'll get into in just a minute. So the first step here is to familiarize yourself with the tax treaty. I'm not recommending that you go print out this very boring document and read through it. I would say you just want to be familiar with the treatment, say, of retirement accounts, earned income, and as I mentioned, capital gains assets, and how that's going to work given your particular circumstances. The next thing I'm going to show you here is deciding on your long-term immigration status. We'll come back to the Heart Act because these two are intimately tied together. Your legal immigration status will determine your tax treatment. Okay, so a couple choices the clients that we present to clients, and they would include: do you want to pursue citizenship if you're on a permanent residency card? Do you want to keep your citizenship if you're already a citizen? Or alternatively, do you want to give it up? And if so, when? At what point do you want to give that up? It's important to note what happens to a visa holder or permanent resident once renounced. It really means that they're outside of the greedy clutches of the IRS and they no longer need to continue worrying about the lengthy list of things that we're going to get to just a little lower down in this tab here. So as I was saying a moment ago, for tax purposes, you're a US tax resident. If you're a citizen, a permanent resident, or you pass what's called the US physical presence test. Now, just as an interesting aside, there's very little to do with what we're talking about tonight. The physical presence test is a fascinating one. This is how you have a situation where you get illegal immigrants in the US who pay their taxes. And that's because immigration status has very little, if nothing, to do with your tax status. So you could be in the US without your papers and yet still have a tax bill. And that's because of the physical presence test. So if you spend more than 183 days in the current year, and there's a sliding scale, 1/3 of the days in the year prior, and then 1/6 of the days in the year prior to that. And if the total exceeds 183, which I believe off the top of my head, it's more than 120 days in the current year, if you were present in the prior years, then you would meet that substantial presence test. So why is this so important? Because there's a bunch of considerations here. We've got ongoing tax and investment complications, which I'll get into just here. Retaining your citizenship would mean you've got a right to reside in the US. Of course, many people have an emotional attachment to citizenship. There's a potential US gift and estate taxes. That applies especially, or I should say, no matter, it would apply to what's called US situs assets. Whoops, I was trying to italicize that, situs assets. And then also the possibility of an exit tax. So what are some of these complications you might run into? We know about the savings clause already, which means you're going to be a US tax resident no matter where you go. First thing we should know about will be what is the treatment of foreign earned income. And the good news there is that in Australia, because the federal rates are so much higher than they are in the US, at least until you hit $180,000 in Australia, 47% tax bracket above $180,000. Before you hit that point, the tax brackets are significantly higher. Now, I should qualify what I just said. The federal bracket in Australia is 47%. The highest rate in the US presently is 37%. With the sunsetting of the Tax Cuts and Jobs Act coming up at the end of 2025, potentially, the rate will revert to 39.6%. But clients that live in California or New York will well know that with state taxes and heavens forbid city taxes in New York City, it can actually exceed the highest marginal rate in Australia, which is an unfortunate outcome for those folks. In any case, generally, it's not something we have to worry too much about because you pay the higher of the two, and if you pay less, then you have to pay a top-up. But because the rates in Australia tend to be higher than the US, or almost always are higher than the US, it's rarely the case that someone's going to owe US income tax for labor for services performed in Australia. Very important to know about your tax filings and compliance. Why? Because it's so easy to do and the penalties are so stiff. I would hate to see anyone be hit with a $10,000 fine for failing to file an FBAR, foreign bank account reporting. There's no tax to pay. It's literally, I have this account at Commonwealth Bank, at ANZ, whatever the case may be, there's the balance. It could be, if it at any point throughout the year it exceeds to $10,000 equivalent, it must be reported. So if you had $10,001 in there or $10,000,001 in there, doesn't matter. There's no tax necessarily because of the FBAR, but remember, you do have to pay tax on your worldwide income. So now that interest rates have picked up a little bit, if you did happen to have 10 million sitting in a Commonwealth bank account, well, firstly, it'd be underutilized, but you've probably, hopefully, fingers crossed, been earning a little over 4% in a net saver account there, and you would have some serious interest income. And that's what the US wants to, that's part of what they want to see with the FBARs, is to make sure people are being honest about what they're earning in their foreign bank accounts, but also in an unrelated but interesting note, it really kicked up into gear because remember the FBAR, the Foreign Bank Secrecy Act, this came about in the 1970s. They only got serious, the FinCEN jurisdiction of this was transferred over to the Financial Crimes Enforcement Network a couple of years ago because of September 11th. So they want to be able actually to track where money is coming from. So that's why they got serious about that. FATCA, we can't forget about that. That's Form 8938. There's a few more details with that one. US estate tax, that's another complication. Really, that's going to come into it if you're a US citizen, of course, or if you're not. I had a good friend and partner, financial partner of sorts, John Versace from Apt Wealth Management, reach out last week and said, and ask, he has a client who's looking to buy investment real estate in the US. Well, the first thing that I want to know is that client a US citizen or not? Because if they're not, it could be a very poor decision to own that real estate, given a little bit of ambiguity with the estate tax treaty that Australia has with the US. Certainly, if they weren't an Australian citizen, if they were from China or somewhere like that, then it would be an absolute no-no. Why? Because the US provides a $60,000 estate tax exemption to what are called non-resident aliens. That means that's the charming term they use for us non-American folks. That would apply to the Chinese person in my hypothetical example right there. The Australians, however, they do have an estate tax treaty, and so it probably would not apply in any case. US expatriation tax, there's the HART Act right there. I'll talk more about that in a minute. PFIX, no matter the number of times I mention this, people still get confused about it. It couldn't be simpler than this. If you are a US citizen or permanent resident and you own Australian managed funds, ETFs, real estate investment trusts, listed investment companies, or any other sort of business entity that produces passive income or meets one of these tests here, which all of them do, you have a PFIC, and PFICs are bad news when it comes to US taxation. Why? Because the default treatment is to hit you with the highest marginal tax rate in effect, which presently is 37%, for every year that you owned that PFIC on any growth that account produced. So that is something you certainly want to steer clear of. Foreign tax treatment asymmetry. This is a pretty obscure thing. This could happen if someone had a second residence in Australia and there was a significant change in the exchange rate. It could be that they have a loss in Australian dollars, but then a gain in US dollars, and then they end up owing the IRS because it's considered personal property. So very unfair that those losses are not deductible and the gains are taxed at ordinary income rates. So, excuse me, you really don't want that. Social Security, this is something I went into in great detail last month, and essentially the story here is your legal status has nothing to do with if you're Australian, has nothing to do with your Social Security status. If you have worked in the US for 10 years, 40 quarters of income paid into Social Security, congratulations, it doesn't matter what your situation was in the US. If you've renounced your citizenship, if you're only ever on a temporary visa, whatever the case may be, you're eligible to get your Social Security benefit in Australia. Another thing that comes up is how will you retain your ability to invest from overseas? I had a terrible thing happen. It started about 3 months ago with a lovely new client that I started working with back around October of last year. Anyway, about 3 months ago, it was December, he was moving from the US, and I said to him, you know what, we really recommend that you don't consolidate your banking and brokerage relationships with the same firm, because their opinion about the countries that they're okay having clients in changes all the time. And if they change, I would hate to see you lose the ability to manage your investments and lose your banking relationship. It so happened he was with Charles Schwab, and we like Charles Schwab. We work with Schwab ourselves, but we don't work with Schwab Bank. Well, the client moved. I told him, you want to open up accounts elsewhere. Do not have your banking relationships with Schwab. And sure enough, now that he's moved, he's living happily in Sydney. We went to update his account information, and Schwab Brokerage, that's the after-tax investment accounts and the IRAs, perfectly happy for him to change his address to an Australian address. Schwab Bank, on the other hand, they said, whoa, Australia? We don't do that. In fact, the only thing you're allowed to do is close. We will not allow you to have accounts if you're living in Australia. So that would apply also to JP Morgan Chase, Bank of America Merrill Lynch. You don't want to be consolidating your banking and brokerage relationships. So needless to say, we work with brokerage firms that don't have a problem with folks in Australia. The last issue here is to do with superannuation. How is your superannuation account going to be taxed when you return to Australia? Here's the situation. It really depends on what your legal status is. If you're a US citizen, well, you're probably going to get caught up in deciding whether it's an employee benefits trust or a foreign grantor trust. And there's a whole set of diagrams that we've produced to help folks guide their way through that so they can determine what applies to them. But if you're not a US tax resident, if you were just on a temporary visa returning to Australia, you could actually have no problem whatsoever if your superannuation account was deemed to be a foreign employee benefits trust throughout your time in the US. Excuse me one second. Just turning the heat off in here, and it's going to be a very cool night in Minnesota. 19, it's dropping. No, that's Fahrenheit, people, not Celsius. So deciding on your long-term immigration status. Next, the HART Act, which, as I mentioned, we'll be going into tremendous detail on that, doing a premium webinar next month. Here's the situation there with the HART Act. If you, I'll zoom into this so you can see it because it's otherwise microscopic. Is the individual a US citizen or a long-term resident of the US? This is someone who's expatriating. So if that's your situation, okay, let's proceed. Did that US citizen relinquish their citizenship, or did that individual cease to be a long-term US resident? What's a long-term US resident? Someone who has held their green card for 8 of the past 15 years. And I did not say held it while in the US. Doesn't matter where they were. They could have been on the moon, Antarctica, Zimbabwe, anywhere in between, as I mentioned. If they've held it for 8 of the past 15 years, they're considered a long-term resident. And if that's the case, then we proceed to the next step here. Did they meet one of the 3 tests? Do they have an average annual net income tax liability? That's not net income, it's a tax liability for the preceding 5 years. In the most recent number in the chart is 178. In 2024, I believe it's up to a little over 200,000. So you've got to be making pretty good income on a married filing joint basis. You've got to be making in the order of $700,000 thereabouts in order to have a federal tax liability of that amount. And then who knows what itemized deductions an individual might have. So it's hard to say. But in any case, if you exceed that amount, and another way worthy of quick mention, that can happen is if you have a big liquidity event from your company, you're leaving the company, you're heading back to Australia to enjoy the good life, you sell your millions of dollars worth of stock, you get hit with a big fat tax bill. Well, guess what that may have done to your 5-year tax liability? That by itself could cause you to be considered a covered expat. The last thing, which is not something we ever encounter, given the kinds of clients that we work with, is the individual fails to certify their compliance with state or federal taxes. That's our mission, is to help people live a comfortable, compliant, globally mobile financial life. So that's the HART Act. I noticed the questions come up here. 8 partial calendar years. Yeah, that's right, Dean. If you got your green card in, say, it was granted December 31 of 1 year, 1 minute of in that year counts as the whole year. It's not day, like let's count 8 years from the day the green card was granted. It's 8 years from the calendar year that it was granted. So ideally, if you're on a green card, you want to be given that January 1st or earlier in the year rather than at the end of the year, because the whole year counts. So if someone, for instance, was given their green card in 2017, then we need, and it doesn't matter the date. It doesn't even matter. I just say, what year did you get it? And they say, oh, I think it was January. Doesn't matter if it's January. What year did you get? Oh, 2017. Let's count it up. 2017, 18, 19, 20, 21, 22, 23, 24. You're going to, if someone arrived in the US, got their green card in 2017, then in 2024, you are considered a long-term resident. So I hate to be the bearer of bad news there. I did skip over one of these things, the global net worth in excess of $2 million. That to me is patently unfair because that is not indexed for inflation. And as time goes by, as asset values creep up, more and more people are getting caught up in this hard act dragnet that they've got because of that particular limit. Now, they do provide some relief. They provide a capital gains exemption, which is indexed, but it's a very dirty trick, and I'll share with you why I use such strong language. It's because of Section 2801, and Dean will be someone who will know that this is new to the presentation, but this is something that I've come to learn from some relationships I've had and continue to enjoy with various tax attorneys. This is a sleeper provision that exists in the Hard Act. And what this one is if a covered expat bequeaths an asset, gives or bequeaths an asset to a US citizen, then that US citizen is on the hook for a 40% gift or inheritance tax. 40%. So this is an appalling situation to have happen for a higher net worth family that don't know about it, haven't received good advice. They move, maybe they pay a small exit tax thinking that's the end of it. Wrong. If they had kids, maybe they have dual citizen children, they've returned to Australia, the kids inherit the estate someday. Well, bad news, kids. If you move back to the US, or even if you don't, in theory, but if you move back to the US, Uncle Sam could be coming after you with a stick, as you see there. So that's the Hard Act. We want to start thinking about that, as you heard me say, at least 3 years ahead of time, ideally 6 on that one because of the 5-year look back. The other point I wanted to raise here that really comes up early in the piece when you start thinking about moving is real estate. It's not so much decide on a primary residence, it's more think about real estate. And the point here is, as many of us will know, this doesn't come as a surprise to anyone here, or shouldn't, but if you go back to Australia, to any of the major capital cities, you're going to be appalled at what's happened with real estate prices. They've gotten absolutely out of control. And unless you live in Beverly Hills, Bel Air, San Francisco, or have a fancy house or apartment in New York City, then it's quite likely that you'll find that even if you've paid off your residence, you've got 0 outstanding on your mortgage, you move back to Australia, the amount of money you're going to realize on the sale of your property from the US may not be sufficient to buy a property of equal quality and size back in Australia. And so we need to start thinking about where are those funds going to come from to be able to purchase that real estate. Another couple questions have popped up. Just getting rid of Dean's chat so we see that. Elaine, can you explain the Hard Act re being a long-term alien resident? Is there a tax when you leave? Elaine, you are absolutely welcome to join next month where we do a deep dive on that question. Tonight's not so much about that. It's about departure planning, but it's a fair question. It's on many people's minds, and I look forward to going into that one next month. So 6 to 12 months prior to your departure, what do you need to be thinking about? And these aren't in any particular order, the way that they're presented here. And by the way, the slide deck looks very similar. As you can see here, 6 to 12 months prior to departure. You're thinking about diversifying low basis investments. Now, the US individuals are not thinking about this. Why? Because there is a gift offered in the tax treaty. It's a wonderful, wonderful thing. And that is the way that the ATO treats your low basis, that's high gain, low basis, high gain investments when you move back to Australia, provided you didn't purchase that asset originally in Australia, then move overseas and then move back again, that would be different. But provided you came to the US, you got your shares in Microsoft or Amazon or Google or whatever, they've grown tremendously. You move back to Australia. Australia says, well, gosh, we really don't know what the fair market value is for that. Sorry, not the fair market value. We don't know what the cost basis is for that asset when you bought it. So we're going to assume that it's the basis, the taxable basis is the fair market value on the date you resumed your Australian tax residency, which, as I said, is just a gift because it means you get a tax-free step up in basis. And these clients, that's why I say start thinking about it 6 to 12 months out. You might be trimming other parts of your portfolio that don't have such high embedded gains in there. Let me see, is there another question? No, it's the same question. Also, the chat's open as well. If you're welcome to use either. I think Zoom is a bit ambiguous with the chat and Q&A, so it's fine to use both. Determine your superannuation tax exposure. That came up in the prior 3-year thing. That was more to do with the complexities as opposed to really getting busy figuring it out. It turns out this is actually a very technical area. This is not a service we provide in 100% of client cases. We refer that to trusted international CPAs who are going to determine what your basis is in super if you're a US tax resident. If you're not, doesn't really matter unless you held a self-managed super fund or were very active in trading your account while you were overseas, in which case that could tip the scales and take you from what was a foreign employees benefit trust where you weren't going to be taxed while you're overseas to this unfortunate treatment, which means you would be taxed. In any case, you want to figure that out, particularly if you're a US individual. Next, PFIX. This is where we begin to sharpen our pencil. We're only 6 to 12 months out from moving at this point. This is where you start to say, whoa, okay, most of my assets are in US dollars. When I move to Australia, my bills are going to be showing up in AUD. So I want to move some money over there and ideally invest it so that I can earn a better rate of return. Well, you can certainly put it in a term deposit or a bank account if you want. That's not going to be treated as a PFIC. Remember, this only applies to US citizens or permanent residents. If you're an Australian individual with no US ties, then you can do whatever you want. These restrictions do not apply. However, for the US individual, really the only way around that is to invest in individual stocks. And when I say individual stocks, I mean you're owning Telstra, Wesfarmers, QBE, Commonwealth Bank, that sort of thing. I'm not recommending those stocks. I'm just saying as an example, you're not buying some ETF that owns the All Ordinaries. You're buying the individual stocks because that ETF would be deemed a PFIC. So that requires some thought about how you're going to manage your financial structure in the event you retain your US citizenship or permanent residency. Next, we're going to compare budgets between the countries. And I think for many people, they find this very dull. I am not one of those people. To me, this is where financial planning is at because cash flow equals, or excess cash flow equals savings, savings equal investments, growth and investments equals wealth. And this is how it happens, is by being able to track what you've got. If you want, you can use these two tools, Numbeo and Expatistan. They will help you back into what cost of living looks like in Australia these days. It's not something I really ever use, to be honest, because as I said, I just moved back from there 6 months ago anyway. So what we do with our clients is we run them through this very, very detailed fact finder where we look at their budget in US dollars, and then you see the USD here in this in the tab. And then we compare that, how to do your foreign budget. Then we compare that to an Australian budget. And so we figure out, right, okay, living in the US, it's costing you about 8,000 or 18,000 a month to keep the wheels in motion for your family. When you move to Australia, it's going to cost more like whatever that difference is. And people can be surprised for the good or for the ill. It's most people would say for the ill, but I've actually seen plenty of examples, my own being one of them, where we moved back and living on US dollars, especially, it helps with the dollar where it is presently, but we were surprised that it was actually more affordable. So there's some good news there. Determine portability and taxation of US retirement accounts. So we spoke about superannuation already. What about your 401ks and 403bs and so on and so forth? Bad news for folks that hold US cash value life insurance. There is an appalling lack of regulation in the US on so-called financial advisors, but financial product salespeople that sell life insurance as some sort of financial Swiss Army knife, where they say use life insurance for retirement planning, for college planning, for this nonsense thing called infinite banking. It's total BS. Australia, since the late 1980s, they've seen through that. So you can take your cash value life insurance policy back to Australia. And yes, you might be able to take tax-free loans from your policy in retirement, but not from the Australian point of view. They're going to tax you on that. And unfortunately, that's not good news if that's what you've purchased. But in any case, we're going to look at the tax situation. Big difference in treatment if you're a US individual versus if you're an Aussie. The Aussie, actually, this is one of the other gifts in the tax treaty, is if you have a 401k or a rollover IRA, not a Roth, sadly, but if you have the traditional tax-deductible type of retirement accounts, then you could be in for some very good news if you're not in America when you move to Australia, because again, there's a way to get a step up in basis with that. I've done webinars on this previously. You're welcome to go take a look on my YouTube channel. Planning for HECS help. This can come as a rude surprise for those folks that are moving back to Australia that didn't take care of their debts before leaving. The ATO hasn't forgotten about that, unfortunately for you. And so you need to be aware there may be a loading applied, 1.5% loading, I believe it is, I'll have to double check that number, applied to your tax rate until that debt is taken care of. So that's what we have for the 6 to 12 months out. Next, we've got the 3 months out. All right, so the tickets have been purchased. You know your departure date. You know when you're moving out of your place, when the movers are coming. A lot of the details are starting to fall into place. So depending on your phase in life, you may be reaching out to recruiters, making that initial warm outreach to say, hey, this is who I am, I'm coming back. I'd love to meet with you in Melbourne in May sometime. It's just around the corner. I'd love to get a feel for the job market and see what's out there. Determine move-related cash needs. So this, yet again, plays to my strengths with budgeting. But this is fairly typical of the kinds of expenses you want to be thinking about. You got your plane tickets, a little cheaper than normal, considering they might just be one ways. You got your shipping for your personal effects. How much is that going to cost is like asking how long is a piece of string. It's going to vary tremendously from one person to the next. We just moved back from Australia, and I shipped an exercise bike. What else did I ship? I shipped a scooter, electric scooter that was pretty heavy. Some artwork, which unfortunately arrived damaged, but we filed an insurance claim and got some money on that. And that was I think it was 3,500 Australian dollars for that stuff. I think the total weight of what we shipped was about 120 kilos, something like that. So if we were to move permanently back to Australia, I would guess that's probably a $15,000 to ship furniture and more stuff. So it's going to vary tremendously. Purchasing a new vehicle in Australia, again, it's up to you how much that costs. Insurance policies, don't forget, in Australia, they like to charge you the full year's premium ahead of time. And then if you cancel the policy, they'll refund you, but they want to hit you for that full amount right up front. A couple months of living expenses, and don't forget about deposits due on rental properties that might actually be payable before you move, which would make sense if you're signing a lease before you actually get on the plane. Here's another one: separation of service notice from your US employer. This pertains to 401ks. So I had a prospective client a couple of years ago, great guy. He worked for Ford, coincidentally, on the Ranger production line, which by chance happened to have been the vehicle they built here in the Twin Cities, Minneapolis, St. Paul, up until about 10 years ago. They moved the engineering team to Australia, and this guy moved with them. And so he was inquiring about services with my firm, and the major account that he had, 90% of the assets that he had was in his Ford 401k. So we got to talking, and I said, well, here's the thing is you're not going to be able to move that 401k away from Ford if they don't give you a separation of service notice. This is something that varies tremendously from one company to the next. I've seen this many times where companies will say, well, the Australian division, different company. Here's a separation of service that allows you to port your 401k. If you don't get one, I'm afraid you're stuck. You cannot move that 401k until you quit that employer, basically. So that's an important thing to know about. Establishing a foreign exchange plan. I have gotten to the point where I can bang on the table, I can yell from the rooftops, but I just don't feel I get nearly the attention that this topic deserves. Here is the thing: you're paying a big fee to convert your money, almost certainly, unless you're using the resources that we make available to our clients, which are mentioned here. So here's a statement of advice I did a couple of years ago, talking about the direction of the dollar. It hasn't been updated in the last few years, but this spreadsheet, the template that is, I should mention, obviously individual advice is updated. But here's what I wanted to show you. This is a spreadsheet. Let me explain this, because this may not be intuitively apparent, or apparent intuitively. So if you're converting $1 million US to Australian dollars at the interbank rate, this is what the banks themselves would get. They would, that $1 million US at today's exchange rate would be worth 1.53335 Australian dollars, 1.5 million Australian dollars. If you went with the lowest cost foreign exchange platform out there, which is Interactive Brokers, you're going to be charged a fee of, a spread of $30.63 and another $2 because that's just what they charge. So $32.63 if you went through Interactive Brokers. There are many, unfortunately for Interactive Brokers, it's a case of you get what you pay for in terms of this customer service. They are shockingly, or can be shockingly bad and very difficult to use. And they won't like it. If you move to Australia and you update your address, they'll immediately close your account. So that comes with some whiskers. The next best available is what we've negotiated using the buying power of my firm and with the Global Financial Planning Institute. We've got a rate that's about half the rate that OFX makes available on a retail rate to retail clients. That's better than any of the Australian organizations out there by about 20 basis points. Next best is Schwab. They'll do, for amounts under $500,000, they'll do a flat 50 basis points. So that's what I have there. 50 basis points is 0.5%. So the fee that you're paying is about $7,700, just rounding up right there. Most people on this webinar would probably be using Wise or OFX. If you get some really fancy people, they'll say, well, I use Revolut. Well, Revolut does charge interbank rate, but guess what? They limit that to $1,000 a month. So all that glitters isn't gold. Jennifer Johnston writes in, if you work for a global company in the US and they agree for you to work for them in Australia on Australian payroll, would the separation of employment need to take place? No, that's the thing. Jennifer, it boggles my mind how this can be. But even when localized to Australian payroll, it's a very, very good question. I love your question. Even when localized to Australian payroll, as my client was with Ford, no separation of service. I've seen it also with some medical device companies where they deem the Australian entity to be part of the same parent group. I would say in 2/3 to 3/4 of cases, they will grant you that separation of service. So hopefully that's the case for you. Okay. So the point I'm making here is you want to be getting a good foreign exchange rate. Obviously, if you're just using your bank, you might be paying 1 to 2%. Even folks that have a so-called preferred relationship with HSBC or JP Morgan or Citibank, one of these global banks out there, the rates are terrible. It's really, they are just not even competitive, and they essentially rely on this information asymmetry that people just don't know how this business model works, and that's it. It's the spread. That's how they do that. In any case, the broader point I'm trying to make here is you want to have an intelligent way to do your foreign exchange, put together a plan for how you expect to convert your money back. This is your life savings, and we want to make sure that you get as much money for your money as you can. All right, so 3 months out, what are we doing? We're approaching the hour mark, so I might just speed up a little bit. This is obviously something a financial advisor doesn't get involved with selling your use assets, or sell your car, sell the stuff you're not bringing with you, determine the shipping. There's actually more to this, and I'm going to write more about this in the future. Determine shipping. There's really 3 options as I see it. There's excess baggage with you on the flight. I'd love to show you. I'm going to include a photo there of what we brought to Australia. We brought 20 bags with my small family of 4. We paid about $1,200, but we had everything we needed for 2.5 years on the way there. And that proved to be the fastest and most economical. There's unaccompanied baggage, which isn't that cheap. And then, of course, there's shipping. So those are really your 3 options. And I'm going to make a point of it to crowdsource some of the best suppliers and best avenues for how to go about doing that, and provide some recommendations in the future. Familiarize yourself with the Australian tax system, understand how retirement works, and how earned income is taxed, how capital gains are taxed, how your primary residence is taxed, especially if you're globally mobile and may move overseas again. You could be in for some rude surprises with that, and the taxation of foreign accounts. Those are the key things you want to study up on. Most of the clients that I work with, I would say, are high-functioning, very intelligent adults. They could do this if they put their mind to it, if this is their passion, and they love the idea of having a checklist. So we produce this departing country supplemental document checklist that we can just print out. Notion, this program that I'm using here, allows you just to press print. I haven't printed in a while, but it's somewhere here. So you could print that out and then have that item, have all these items here to tick and flick, so that you know exactly that you've got everything obtained. Next, where was I? Okay, comparing budgets again. That's something that doesn't really stop. The reason that's there again is because you're now going to have a better idea as you get closer. You might have zeroed in on a rental property, and you know your rent's going to be $1,200 a week or whatever the case is. You want to identify your advisory team members, and I would say it's universally a surprise when folks realize that living a globally mobile life does come with an added burden of advice. The full team if for a higher net worth client with a complex financial life would look like this. You've got your US international financial advisor. Well, happy to meet you. That happens to be what we do. That's our seat. You've got your foreign country financial advisor. We work very closely with apt wealth partners in Australia, not exclusively necessarily, but that's who we've had a lot of good experiences with. You've got your international tax professionals in the US and Australia. We're working more closely with a single firm in Australia, the only firm outside of the Big Four that will do both Australian and US tax returns. International estate planners in the US and Australia, and then insurance professionals. This is really about bookended advice so that you're getting advice that's congruent from both sides, and you can have those constructive conversations if someone says something that is contradictory. I just had a great email from a client of mine, a wonderful guy who spends his time between Sydney and New York, excuse me, and he was in touch with his Australian insurance agent. He said, well, I'm sorry, excuse me. Should I, what do you recommend, Ashley and my Australian insurance advisor, with life insurance, with disability / total and permanent disability insurance between Australia and the US? And I was able to say, for life insurance, you may not need it given your circumstance, but if you do, then you'd be better off getting that in the US. TPD, the way to answer that is because none of the products out there are very globally oriented. They have a restriction in them where they'll only pay you a benefit for 6 months if you're out of the country. So my answer to the client was, really, you need to buy that policy in the country that you want to be in if you end up going on claim. Not a happy thing to have happen, but if you did go on claim, then it turns out he wants to be in Australia, get that policy in Australia. Belinda's raised her hand. I've seen that pop up. Maybe, Belinda, you want to type in your question there. I'd be happy to answer that. So identify your team members, update your household balance sheet. The purpose of this one is really to figure out, what do you plan on migrating to Australia? That might be, say, 401k or rollover IRA, for instance. You've got an after-tax investment account, the low basis stocks. There needs to be a plan. We use a spreadsheet that we've designed called the Client Investment Plan that shows how assets move from one country to another, but you're welcome to come up with your own. But that's something you'll want to do, is figure out where is the final resting place for a particular account. Again, confirming your authority to invest in an account from overseas, deciding on that primary residence. You're getting more specific about that now. The reason that I have this here within 3 months of departure is you've figured out prices, you know what the market is on a live basis. You're looking at realestate.com.au, a domain or whatever, every day, you know what the listings are, but you're not living there yet. You don't have that real familiarity, and that's where I would say you want to defer that to your arrival before buying, unless you're extremely familiar through constant travel or family or whatever the case may be. I'm going to end tonight's presentation here with the shortly upon arrival, because we veer off into a whole other presentation when we talk about arrival planning. Some of these things are pretty straightforward. Clients tend to be overwhelmed when they've moved. They've gotten used to this whole new world. They aren't so interested in reviewing their auto, renters, or homeowners insurance, depending on the case. But I would say now is the perfect time to do that, because once the policy's in place, then it could be more difficult to change carriers. Enrolling in Medicare, that's obviously something you'll want to do as soon as possible. Be in touch and find out whether this lifetime health cover loading might apply to you. Let me see. Sorry, there's a question here. Jed's written in. I'm an Australian citizen on an L1 working in the US. Hi, Jed. Got married to a US citizen last year, so was going to file married filing joint, but we are planning to return to Australia soon. Okay. Can we file married filing joint now? Then I claim closer ties to Australia, so I don't have to file US taxes while in Australia, and my US spouse will just file married filing separate. You've got a very good understanding of the situation, so I acknowledge you for a very intelligent question. the devil's in the detail as to whether or not that would actually make sense for you. The key term you want to go and research, Jed, and I've done a webinar on this, I think it was about 2 years ago, the 6013G election. There's a section in the Internal Revenue Code, 6013G. You have a once-in-a-lifetime opportunity to opt yourself in to the US tax code so that you can retain the ability to do married filing joint while back in the US. Many pros, many cons, probably more cons than pros, but there are situations where it would make sense to voluntarily opt into the US tax system. So I hope that's helpful. Go check out that webinar, and that's really a better question for an international CPA if you wanted to really go into the detail on that one. Okay, comparing budgets again, reviewing homeowners insurance, buying your use assets, deciding on a primary residence. That's really what I had for you there today. Elaine writes, you said you have a YouTube channel. Is it under Arete or Arete? Actually, everyone calls it Arete. It's not. It's Arete, derived from Aristotle, meaning excellence of character and virtue. Is it under? You know what? I'm just going to type the answer here because I have it in a short code. There it is. There is my YouTube channel that you're welcome to go and look at. Would income from a rental property fall under PFIC? No. And it doesn't matter if it's professionally managed, but what it would matter is the rental property held within an entity of some sort? Do you have that in some kind of corporate wrapper? Because if you do, bad news, you've got yourself a PFIC. All right, let me go back to my slide deck over here. And we've gone through all of this shortly upon arrival. Next month, as I mentioned, we're doing a deep dive on the HART Act, the exit tax that we're talking about, the tests, and even going as deep as to how is this exit tax actually determined. There will be a fee for that webinar. Again, the proceeds will be donated to charity. If you'd like to know more about anything I've spoken about today, or you feel like you wanted to have a complimentary call to see if we might be a fit, please come to our website, arete-wa.com. Click on the Get Started there. There'll be a couple questions to fill out, and then you're welcome to find a time. Next, we've got some key financial data sheets. This is a data sheet that I put together that has Australian and US tax information on it. So it's a handy dandy printable document right there. And lastly, that's really all I have for you tonight, and right on time. So just wanted to say thank you to everyone and give you one last opportunity to answer any other questions, concerns, or doubtful points that anyone might have from tonight's presentation. While you're typing that in, I'm just going to have a quick drink of water here. Okay. Well, it's been a pleasure. Thank you so much for joining me here. And I hope you can join me in March for a deep dive on the exit tax. Have a wonderful rest of your evening or day. Bye-bye.